Good evening, everyone. We thank everyone who have joined this workshop on Introduction to Derivative. I'm excited and honored to present it. I would also take this opportunity to thank the team at Tadawul and the Invest Wise program for their devotion in increasing awareness when it comes to all matters related to financial markets. To start, I'll be covering three major categories. That would be some background on derivatives. Then we will look into how to trade while going through some examples, which is very important to understand. And then we will also touch on the topic of margin requirements. So this is a little bit about myself. Okay. So derivative models. First, I would say we want this to be as engaging as possible. We want it to be fun and enjoyable, and also we wanted to have that kind of important knowledge, especially that Tadawul is actually we will be launching soon the first derivative exchange traded derivative in Saudi. So we start by defining a derivative. So a derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets. So again, it is contract between two parties. Terms and conditions are set today to deliver a certain asset at a future date. On the expiry date, the underlying asset will either be delivered as a physical settlement where you will accept delivery of what is the underlying, or it will be more of a cash settlement, which is the price differentials between the price that the underlying has been bought and the settlement price at maturity. Usually buyer and seller in the derivative markets, specifically in the future markets, can actually close or unwind or withdraw their positions before maturity. That can be done before the last trading day. And we will be talking about how how can this basically work, and what is the mechanics around that. Or it can be actually settled towards the at maturity at the settlement price. Basically, there is examples that can underline or be examples of underlying assets are a lot. We're talking about stocks, financial indices, bonds, interest rates, foreign exchange. There is a lot of basically anything that have a variability around it, and there is a buyer and a seller that are willing to enter into a contract to manage that variability. There's even currently there is derivatives on weather to hedge against the risk of weather-related losses. So just to give you just for your imagination to understand how underlying can be a wide range of things. So very important here to understand that derivative transactions do not involve change in ownership, and their price is derived from the price of the underlying assets, hence the word derivatives. Okay, so people might think that is a new concept, and to the contrary, that is actually a very old concept from the times that the contracts of futures were written on clays in Mesopotamia to the times that is around 40 years ago when it started to trade electronically. So and we're talking here more than thousands of years ago, where the concept of derivative is there. And actually, there is a story maybe relevant to this slide. That's the one of the famous stories on derivatives for a Greek philosopher, Thales. That is 2,500 years ago, when he decided to buy the exclusive right to use all of the olive presses in the town after the harvest. Now, since that deal he had was in the winter, there was no way to know if the olive harvest would be good. So he was able to secure the contract at a lower price. On the other hand, if you put your shoes in the place of the owners of those presses, they basically saw a chance to mitigate any risk as a way to make at least some of the losses if they would incur if the harvest turned out to be poor. So fortunately for Thawes, the harvest was excellent, and the demand for olive prices had spiked, and he made a huge profit by renting these presses. So again, derivatives are nothing new, but the evolution of an old concept. Okay, so what are derivatives being used for? There are different uses for derivatives, and they are in our daily lives. So you find the manufacturer use them to help lock in some of the cost of some of the raw materials they use, or the debt they issue. You the exporters using them to achieve certainty around receivables, their revenues if they have foreign operation and they are exposed to foreign exchange risk. So they use derivative to manage that. Food producers and distributors use them to manage agriculture commodities, and this is one of the core actual historical needs that brought derivatives into play. Energy producers and distributors use them also to manage changes in energy price, oil and gas, and other kinds of energy. Banks use them almost daily to manage interest, liability, and risk. Basically, banks use them dynamically as part of their asset liability management, what they call ALM programs, where the banks could manage the volatilities on earnings. Airlines use them to manage fluctuation in fuel price. Fuel, as some of you may know, constitute around 30% of total airline expenditure in a given year, and I can say it's a common for airlines to hedge fuel purchases well in advance. That's why we see airlines have the opportunity to expand at times of high fuel prices, and at the same time not benefiting when fuel is cheap. So as you can see, there are a lot of uses for derivatives in our daily lives. So this is a look on the global derivative trading in terms of exchange trading. When it comes to equity index and individual equity derivatives, they have accounted for 53.8% of total volume, i.e. number of contracts in 2019. So that gives you a sense of the number of contracts we're talking about here. And it comes difference. It can be equity indexes, it can be rate, currency, energy. As you can see here, the size of every exposure and the number of contracts that is aligned with it. Of course, derivatives are traded on both exchanges and over the counter. which is something we will be talking about, what is called the OTC market. We will soon also look at the difference between both. Okay, so this slide gives us a glimpse on both the OTC market and the exchange traded or the exchange market. So the daily average turnover of and it's covering exposure, the foreign exchange derivative and interest rate derivatives, and the daily average turnover of both interest rate and FX or market worldwide, sorry, has jumped from 11.3 trillion in April 16 to 18.9 trillion in April 19, and we are talking here about the daily average turnover. And when we say these, you might be asking, this is huge numbers, trillions. This is basically the gross notionals. So derivatives you can look in two ways. You either can look at the derivative as a gross notional, or you can look at them as the market value of them, and it differs very much. A market value will be a fraction of these big significant numbers, but it can give you a sense. So when it comes to currency and interest rate, the numbers are mixed. You can see in this graph, we can see how OTC trading of FX derivative also goes substantially according to the graph. In OTC markets, the daily average turnover of FX derivative increased from 3.4, as you can see on the right side, to 4.6 between April 16 and April 19. By contrast, exchange, it remained at merely 0.1 trillion. However, on the other hand, the volume levels are bigger when we look at the interest rate derivatives, and that might be explained by short-term trades that aim to fix variability in short-term interest rates. There are very such products who are very short-term and fill that purpose, such as what they call forward rate agreements, FRAs, as they are more common in exchanges than they are in the OTC market. So looking at interest rate at a certain point in time from a total outstanding derivative position paint a different picture for us, but this is useful just to have a sense of the daily worldwide exposure. So in the OTC market, usually interest rate derivative has the biggest share, followed normally by FX, and then the third comes as credit derivatives that deals basically with credit events and default events. Just a number to throw here, as of June 2018, interest rate had constituted around 84% of the gross nominal value of the OTC market. And again, in the OTC market, the interest rate derivatives comes more of a long-term customized and basically swap transactions. So it's basically constitute most of the transactions in the OTC. But yet we can see that daily action or activity that happens in both OTC and exchange is huge on a daily basis. In Saudi Arabia, as per SAMA 2018 annual report, Saudi Monetary Authority, OTC derivatives activities was more than 1 trillion Saudi riyal. So derivatives are not entirely new in Saudi Arabia when we consider the OTC market. So benefits to the kingdom and Tadawul. I would start here with it does provide new instruments to trade, hedge, and arbitrage. And I would stop at this point basically just to see who typically trades derivatives. So trader derivatives are going to be either hedgers, speculators, or arbitragers. And hedgers enter into this market to reduce risk by fixing the price. Speculators take risk and bet on the market, and hence they are subject to losses or gains. And arbitrageurs who normally take short-term offsetting positions to lock in riskless profits. So an example of an arbitrager who is basically someone who would trade a stock in two different indexes, the same stock, the same company, but they are in two different indexes, and one stock is cheaper than the other. So he would actually buy the cheap one in one index and sell the more expensive one in another index, and in this way he can actually book a riskless profits. So this is important, just to give you a sense of who would be jumping to basically trade into derivative instruments. And these are the three main categories, I would say. Second, we have efficient price discovery and enhanced transparency. And what does that mean? So an important aspect of derivatives trading refers to the aspect of information transmission. And that is because the mechanism of information transmission plays a central role in achieving financial market efficiency. What we mean here, that the quicker the new information is incorporated in asset prices, the higher is the information efficiency of financial markets. This also can be called price discovery. So this is why derivatives are assumed to play an important role in price discovery, as they offer market participants the possibility to price their expectations of future states of the economy and the underlying assets. With derivatives, I would say expectations about future prices of the underlying become somehow measurable, and that is very important. It provides new employment opportunities in the kingdom within the derivative space, future funds managers, market makers, brokers, risk managers, and that is true, actually. And it does have its own I would say requirements and needs. So basically it does have that effect in employment opportunities. For selling futures is a popular trading strategy, and that can be for either trading or either hedging you. So a trader can take advantage of a downward moving market. And here we're saying that is not as the same as short selling. So you do not need to borrow the assets nor lend the assets. It does have that short selling component into it embedded. And also it can do that important job hedging should you want to protect your assets under management. Fifth, it is an integral part in the capital and financial markets ecosystem, and that is very much true. Most of the advanced cash markets have an equally as advanced derivative markets that goes with it. So that is indeed. And liquidity brings liquidity and deepens the local market. And that is also as well true, because derivative markets have been a contributing factor to liquidity, as there are traders who trade between both cash markets and derivative markets, and it offers more engagement with the cash markets. So what would be derivatives risk? There are actually many, but I would say these in front of you is four important ones. And I would start with leverage risk. So leverage is basically a double-edged sword, because it does provide that gain, significant gain based on how much was invested, and it also can have that big effect in losses. Derivatives are a adaptable and can be used as explained for different reasons, hedging, arbitrage, or pure speculation. But however, what if a bet someone makes starts to go in the direction? The results then can be devastating. A leverage example will be explained at a later slide. Volatility risk is also one important component, and we will also elaborate more on the importance of volatility. So basically, since we are saying that the price of a derivative is derived from what is the underlying, so the volatility of the underlying plays a very major role. Understanding that is also a very important thing to do. Liquidity risk is basically the risk that a trader would take due to lack of liquidity, that can be manifested in the wide spread between the asks and bids. And basically this is when somebody wants to close his position and find issues in terms of getting a fair price in the markets due to liquidity that is lacking. So liquidity risk is one component. Buying end risk is basically when somebody accept deliveries, and having to do that is also a risk, unless somebody does need to have that delivery. If you just a general example, if you are trading in futures in oil and you are not a refinery and you didn't close your position, you would be, in this case, you wouldn't be wanting to have these barrels with you at the end at settlement. So managing that is also very important. Further to that, there is the fact of any charges that can happen in cases like these. So when we talk about features about futures contracts, what are the basics? And some of the features here is that derivative markets open earlier than cash markets and close after the cash. So pre-markets and after market trading is used to measure the regular market open and provide investors with news releases and updates that aren't presented during normal market hours. Futures, in some instances, in a lot of instances actually, and you can see it in a daily basis sometimes with other markets, that has led the cash markets. It's observed the market news before others and led the cash markets, and also attract liquidity at times where the cash market is closed and there is a kind of reflection on some of the news or some of the announcements. So that's some of the basics. Of course, if anyone wants to trade Saudi market, then trade the index future, and we will talk about that, and we'll talk about what the index future here is representing. So what are started when we talk about the size of the market? So what are the types of derivatives? So again, we said that derivatives are traded in both in exchanges or OTC. So what are the types of this is just showing a comparison between both markets. So the types of derivatives you would find normally in exchange traded are either futures or options. It mainly sums it up. There are others, but this is the main components or main, instruments that would be in exchange traded. In OTC, you would find forward swaps, and you would find basically anything else that can be customized and mutually agreed between a buyer and a seller that can be in the OTC derivative, and including very exotic instruments that are there. Trading costs in the exchange traded, it becomes lower. It is or higher in the OTC market over the counter market. The default risk, of course, in this area, exchange traded does offer that kind of important protection because it somehow mitigates and manages that default risk due to having that central clearing and the initial margins and managing that positions. So that alone can help a lot, if not eliminate the risk, the credit risk, the default risk in this case. In the OTC, you get less protection in this category against default risk. Um, although OTC, the default risk is mainly managed bilaterally between the parties, and you find it normally governed by international, by certain documents such as the International Swaps and Derivative Association, which is a document called ISDA. That document would provide netting of obligations. It comes also with a credit support annex, what is called also a CSA, also manages the collateral requirements, but yet it is providing less protection, definitely, if you compare it to the exchange traded. Market risk, when we're talking here about if you want to get out of your position, of course, when it does make sense, because when you're talking about a standardized product, it becomes intuitively easy to find a match, and you get out basically from your position. So you just can go ahead and reverse. If you bought a contract, you need to enter into an opposite one, and we'll get to that, and vice versa. And that can become more easy done in exchange traded, not as it is when it's an OTC market. When in an OTC market, it becomes more, you need to renegotiate some of the trades or enter into a mirroring trade that can actually offset the original trade. So it's the case, and it's not as easy to exit your position when you compare it to the exchange traded. Price fluctuation limits, there are limits set by the CCP, the Central Clearing Party, and the OTC, there is no such thing. And of course, contracts, as we said, in the exchange traded, they are always mainly standardized contract. On the contrary, in the OTC, they become more of a customized contracts, and this is a thing that you can have maybe a two view on it. So standardization is definitely useful, yet some advocates of the OTC market find this as a disadvantage for some hedgers, because customization is beneficial for hedging as it reduces basis risk. And I will be talking a little bit more about basis risk, and I will be shedding some light there. On the clearance side, so centrally cleared CCP, so all trades are cleared via the CCP on exchange traded, but however in the OTC they are traditionally not cleared. However, more regulations now for a centrally cleared OTC trades are happening without the need for it being exchange traded. So this is about major differences between an exchange and an OTC market. So types of derivatives. I would say that you see in front of you the major four, I would say those are the four major families of derivatives: the futures, options, forwards, and swaps. And what happens is that they mainly become the building blocks of something more complex. So you can combine options with some forwards, or options with futures, or combine them, and they are. But however, these four becomes mainly the building blocks of derivatives or financial derivatives. And futures, you find them more there is more activities on the future. You find them more into the energy or agriculture side and commodities. Options, they do basically with different asset classes. You find them in equity, you find them in also interest rate, you find them in foreign exchange. Forwards, you find them as a dominant factor in the foreign exchange market. And I guess you'll get to see that the forwards, they are different here. As you can see, they are different than the future, and the major difference is they are not customized. However, sorry, they are customized. However, the futures are more of a standard. And you would imagine that that will be fitting better for foreign exchange, since normally the requirements of foreign exchange do come customized. So activity is very high on the forward market. Swaps do dominate in the interest rate side, and when we say swap is basically exchanging one cash stream with another. You would exchange a variable cash stream with a fixed one, or vice versa, and they do constitute they do play a major role in the interest rate risk side, and they do also constitute a big portion of the OTC market. So these are the major one distinction, an important one between forwards and futures. Forwards are not mark to market daily as futures, and we'll be talking about marking to market on a daily basis. So I will be planning to launch other instruments in the Saudi market in the future. So when we look at a future contract, again, an agreement made today between a buyer and a seller who's obligated to complete a transaction at a date in the future. Future currently are also traded electronically in an organized exchange, and you would be expecting something like you can see in this slide, this order book, and it's not something different than current, I would say, the order books that you normally see in the stock market. So there is the bid and there is the ask, and you see the price there in order. So again, if it's traded electronically, the buyer and seller, they do not know each other. If what we want to explain, what's the concept of long here and short. So if trader have actually opened a position where he is a buyer, he will be buying the underlying, so he's exposed to downward movement. I would say he will benefit if prices went up, so he is basically long. And for a seller, he would be short. So when will he benefit? He would be actually benefiting or making money if prices goes down. So the concept here is short, and long is a buyer, and short is a seller. So again, the buyer and seller can close their positions before the settlement date, and that basically can be done by entering into a reverse position. So if you are a buyer, you are a long, you can enter into a reverse position where you are a seller, you go short. That matches exactly the contract of your contract, and in this case, you have a match transaction where you can either gain or lose. However, you would be closing your position this way. You will gain or lose depending on where the market movements at the time, and we'll come to that also. If a trader have decided to wait until the expiry date, this will be basically closed at the settlement price. Settlement price is mainly the Thursday of the expiry month. So we will have expiry months, let's say October, November, December. It comes as the third Thursday. So the clearinghouse, the CCP, what's the function of the CCP? So the CCP will be the buyer for a seller, basically, and the seller for every buyer. And this is a very important concept, and this is what can create liquidity. This is what also manages the risk of the credit risk or the default risk. So these are some of the features of the future. So we're talking about the contract code, which is SF30. Is it delivery, the delivery or settlement, cash or physical? Sorry. We're talking about what's the maximum number of net long or net short, and we will talk about that. So we will be talking about how there is there's a factor here that is important, how much you can go long and how much you can go short, and that's also confined by the CCP. Contract size, what's the multiplier, which is 100. The futures maturity date, trading hours, the acquired margin, which basically around 10%, and how to calculate the final settlement price. We will into that. So future contracts do represent a zero-sum game, and when we say a zero-sum game between a buyer and a seller, we mean here that if somebody enters into a position and a buyer enters into a position and he's gaining, that would be on the expense of the seller. So at the end of the day, it will actually balance out, and we will see that by an example. So it's a zero-sum game. If the buyer is losing, that means that goes basically as the gains for the seller, and vice versa. As said previously, contracts are used for hedging, speculation, arbitragers. Hedging and speculating are complementary activities. As we said, hedgers do shift the price risk to speculators, and speculators are very happy to observe that price risk. So an important aspect of future trading accounts is that margins and also leverage. So concept of margin is very important. This is the money that would be deposited to open a trade. And when we say open a trade, it means either you go long or either you go short. Either you are a buyer or either you are a seller. And the initial margin would be that amount you need to put in order to open that position. And we'll be talking about valuation margin also, which is that margin that will be following and seeing where the market movements are, what we call mark to market. And that also we will be covering. So these are important concepts: initial margin, variation margin. So when you open a trade, you put an initial margin, and we will see how that does create that leverage effect that can play in your favor or against you. So how to succeed in actually trading futures? I guess the question you would be asking yourself, you're entering the market in what capacity? Are you hedging or are you trading? And that's very important. If you are, derivatives are typically risk management tools. If you go back to the history and go more of the stories that I just mentioned, one of them, you would find some of them are being used mainly to hedge a certain variable that is the underlying, whatever that variable is. So with better management, derivatives could act as an insurance or hedge to the portfolio of assets. And alternatively, trading the market with caution, with good management, could be also an opportunity that someone can make an additional income stream. So as you can see here in the graph, this is giving a snapshot as of June 30, 2020, regarding the MT30, which is the underlying of the future, the subject future here we're talking about. And when I look at this graph, I want to say that basically volatilities is a core concept in financial risk management. It is important for hedgers and traders in general to understand the risk profile of the underlying, as futures are simply a linear function of a profile. And what is meant here at price movement in the underlying asset of the future contract would translate directly into a specific social value per contract. So in this graph, basically, you would see that we can have a sense of the risk return profile the MT30 and what to expect from the index future SF30. So for a 5 years investment horizon, one expect an annual volatility of returns of around 20%. This when looked at with returns and investment strategy over the same period could be one of the starting points in considering a hedge or an alternative investment altogether, while we need to understand, of course, that historical performance is not necessarily an accurate reflection of future performance. So it's important to look at the fundamental before actually entering, and that goes for index here, or it goes for any kind of derivative. What is the underlying? What volatility are we talking about? It will play a big major role. What is the product that we're talking about? Is it like more of a future, more of a linear product, or forward, or it's something that is not linear, that does not reflect directly one-to-one relationship between the underlying and the instrument that is hedging the underlying. So type of future contracts we will have here. Future contracts can be, we will be looking at index future contracts, which is the one that will be launched by Tadawul, and single stock future contracts. So index future contracts, future contracts that are basically based on financial index, where traders can buy a contract today and settle it at a future date. When we're talking about a position in an index future, you're practically having an exposure with the stocks comprising the index itself. In this case, the MT30. One feature in that index future that is the delivery factor. So it's basically is a cash settled, and it sometimes does have a different multiplier for each index futures. You can look up one of the most famous ones is the E-mini S&P 500, one of the most traded index future contracts. But again, it's very important, and we are looking at the stocks that does constitute that index. This does plays a factor on the future, that the subject future that we are looking at or analyzing. So what is the underlying? It's the it's MT30. That is the MSCI Tadawul 30 index. It's a Saudi Riyal denominated index, jointly launched by MSCI and the Saudi Stock Exchange Company, Tadawul. It does target the top 30 securities in the Saudi market. And I guess important thing here that it does represent about 80% of the Saudi main equity market value. So it is called, the code of it is SF30. The future of the buying index, MT30. Okay. So again, as I mentioned this, when opening a position, that doesn't mean buying or selling future contract. It doesn't, you don't say, and I'm open the position just because you have bought. You are buying at maturity. No, you are having a position open even if you are a seller at maturity. Closing a position means taking either the opposite position or settle at the expiry date. So these are two ways of doing that. Gains and losses are realized when the positions are closed. However, they are marked to market also on a daily basis, but they are realized when the position is closed. Again, the volatility concept comes back. The volatility of the derivative determines the potential amount of gains or loss, and the volatility of the derivative is a function of what the underlying is. So one important concept I would like to shed some light at is the importance to understand the relationship between spot and futures. So the bases should converge towards zero, and when we say the bases, is it's important to understand that this spot price is of the underlying is the price for immediate delivery. That's the price for now, for delivery now. The future price is the price that you can get today for a delivery at some price, some future point in time. What is the basis in this case is the difference between the spot and future prices. So if we are close to delivery or we are close at expiry time, this should get minimized as closer as we go to the expiry date. It should reach zero. And as far as we go away from the spot, if the contract will be delivered in a month, contract will be delivered in a year, we should expect, in most cases, we should expect more bases. The meaning the difference between spot price and future prices is different. And that can be, by the way, a positive, meaning the spot is more than the future, and can be negative, where the spot is lower than the future, and depends on how the curve of that underlying looks like in the future. Is it an upward curve or it's a downward curve? What if they do not merge, mean they come together at expiration? If that didn't happen, then basically looking at the efficient market theory, arbitrageurs in this case will come into play. And we explain the arbitrageurs. Those are the people those are the traders who are trying to take riskless trades. And I would say that this is a riskless trade. And I would tell you why. So for the example that is mentioned here, if the underlying is above the future price, this will bring in arbitrageurs or speculators or hedgers, and that is why, because they will be buying the cheap future contract. Let's say, just put for you an example, let's say if the settlement is after a minute, the of the future is after a minute. That's an imagine, just it's not maybe a realistic example, but let's say that this is after a minute, and if that's the case, you would find arbitrageurs buying cheap future contracts rather than the underlying, and this will create demand for future contracts, pushing the price up towards the underlying. So they would make a profit, riskless profit, by buying the contract that is cheap and buying the underlying that is relatively more expensive. And this is how he would be closing his position, and he would be making money. And vice versa. If the future is more expensive, and let's say the expiry date is after 1 minute, you would find arbitrageurs coming in and buying the underlying and actually selling the future, which is the expensive one, and making that kind of money. So eventually, when the pressure comes, you would find pressure on buying the futures or pressure on selling the underlying. All of that will play a major role in making them both reach what is called an equilibrium, or a balance between them. Eventually, that will put the bases at expiry equal to zero. That should happen, should hold, to prevent arbitrage. And of course, just not to confuse you, and when I'm talking here, we're talking about floating future prices. We're not talking about future prices that have been already agreed upon a week ago or a month ago, so they have a fixed delivery price. We're talking about future prices that are not traded, that are floating in the market. When we go towards expiry date, they should go very close to the spot price. If that didn't happen, there will be a chance for trades that are riskless to happen. And if they do happen, happening enough will eliminate the trade or diminish the trade, and we will go back to, there is no profit in it, and we will go back to zero. So this is an important concept, just to understand here what's the relationship between future and spot. So how to trade? First, this is important. We want to go through these examples, and I want to give you a chance to just have a look at them for a couple of seconds here, and then we will just discuss a bit. Okay, so notional value of the contract, which is the contract price, the notional value of the contract equals the contract price multiplied by the contract multiplier. So you can see on the right side here, there is the contract price 1000, 1000.5, and 1001. And the contract value is just basically multiplying that, contract price with the multiplier, which we said it will be 100. And we're talking the size, that's the movement between one contract price to another, will be 0.5. So in real terms, that's a 50 real move if you took the 0.5 and multiply it by the multiplier, which is 100. So looking at the example here, we would be looking at, say, how do gains and losses are calculated in this case. We see down there, we see a buyer and seller, and that's the position in day one. So if the contract, the future price, the index future price is at 1030, and this is even for both buyer and seller at day one, and you can see simply simple math in day two when the price goes up 1025. Basically, we are, from a buyer perspective, we just said that he will gain if prices goes up. He's a buyer, he's buying it cheap if prices goes up, and the seller will gain if prices goes down. He's a seller, he will gain if prices goes down and he sell at an expensive price. So when prices goes to 1025, you find the buyer is losing 500. It's simply the 5 multiplied by the multiplier 100. That's the position that you will be losing in day two. That's what you will be seeing in day two. And the same thing goes to, you remember when we said it's a zero-sum game? So that's the zero-sum game concept here in front of you, as you see that 500 has been lost by the buyer, and it is a gain for the seller. Now, the third day, things went to 1050, and just simply you will look at the price 1050 for the day three, and just subtract that from the open price, day one price, which is 1030. That's 20 multiplied by 100. That's a 2000 gain for the buyer and 2000 loss for the seller. And day four is the same idea. You see how they have accumulated there for the buyer when the price jumped from 1030 to 1080. So this is how this simple way of looking at this give you a sense of what would you be expecting. We need to just, what is important to remember: what's the contract price, what's the contract multiplier. Contract multiplier is an important point here, just to understand how your gains or losses are looking like. So example here on the direction example, something the same here. So we're looking at this position at the second of September, and the dark blue here is the cash index. When we say cash index, that's the MT30, that's the underlying, and the light blue is the future index, the S30. And in the second of November, you will find a trader who is, if let's say a trader who is bullish. Bullish means that he's optimistic about prices. Prices will go up. He is bullish about prices. So what he does, he go and buy one contract. He will buy the one contract at 1,206. That's the future. and he's buying that contract for delivery in September, which is, as we said, the third Thursday of the month. So he entered into the contract. He is a buyer. He's exposed. He will benefit if prices goes up at 1,206. You multiply the value of the contract with the multiplier, which is 100, and you get 120,600. That's the position. That's the exposure. That's an exposure that you have taken on the future, and equally you have taken on the underlying itself, the MT30. So that's exposure to the market here. However, that's the exposure, and there is a difference between exposure, what's the amount of money that you will need to put, and in this case, the amount of money that you will need to put is the initial margin. As we discussed, when you open a position, you need to put an initial margin. So we will need to put an initial margin. In this case, as for this example, it's 10,000 Saudi Riyal, or can be 10%. So when you put the initial margin, so that's the position you have entered. What happens in the 10th of September? So 10th of September is basically another settlement date. However, it's somewhere in the middle there. So 10th of September, the prices of the future and the market. So the market moves, the price of the future moved with it. So the market moved, the index future, the MT30 is 1,300, and the future is 1,310. So this is a position, this is a point in time where you can actually exit your position. Now you're a buyer. In this case, you need to sell in order to your position. So if you look at this situation here, basically your mark to market, and when you say mark to market, what is the fair value of your position as we stand? What's the fair value of your position as we stand? So when we look at that, so you would see 1,310. If you subtract that from 1,006, you get 104. That's the difference. You multiply it by the multiplier. You get a position, a profit of 10,400. You do profit because you're a buyer, and that's a profit that is not related to the initial margin that you have put. You put at September 2nd, you have put 10,000 riyals, and this is a profit addition to that. So what happens at expiry? At expiry, you basically, if you want to keep, if the trader want to keep his position at the last trading day, then it will be settled at that day, at that price. So what happens? That market went down, so it reached us up as we're talking about the underlying, the index itself went from 1,300, it went down to 1,250, and the future price went also to 1,250. Remember the concept, the spot forward convergence. So that's the same concept here. You will find the future prices at when it's very close to expiry, they go back to and they become very much around zero when compared to the spot market or cash market. So in this case, we will be talking about again here for settlement around 4,400, as can be seen here below. So this is what will basically happen in a life cycle of 1 month if this is how the market reacted, and we're talking here about a bullish case. Now, we just talk about a trade that is somebody who's trading the market, money, have a view, he's bullish. Now, what if you want to hedge, basically? And the example here says that if a portfolio manager who manages a portfolio, so the equities that tracks the MT30, the underlying, and it's worth Saudi Riyal 10 million, and wants to hedge 50% of his portfolio. So simply, he has a 10 million portfolio and want to hedge 5 million out of that portfolio. You would see there that, first of all, if he will be hedging, he will need to come up with the number of contracts that needed to do that hedging or to arrive at that hedging. So in this case, we want to reach the number of 5 million. So in that case, the 10 million, if we took the 5 million and divide that by the value of one contract, which is 100,000, by 1,000 is 1,000, let's say, if the contract price, and multiplied by the multiplier, so 100,000. So we get to know here that to achieve that goal, we need 50 contracts. So now he's hedging. And if he's hedging, so he owns the portfolio. He gains if market goes up, so he will lose if market goes down. So he owns these assets. So in this case, he'll need to sell the 50 contracts. So he sells the 50 contracts. This is in anticipation of markets fall, markets went down. So in that case, he will sell 50 contracts, and the 50 contracts constitute around what, 5 million, which is half of his portfolio. But luckily for him, he doesn't need to put other than the initial margin, and in this case, it's 10%. So it will put us at a position of he will just need to put 500,000 Saudi riyal just to achieve that goal. Now, he made a good call. The hedger made a good call. Market actually went down. As you can see, market was at 990. That's the MT30, went down to 90. So the market went down by around 10%. 10% from his 10 million means 1 million Saudi riyal of loss that he had in his portfolio. However, he does have a hedge in place. So the hedge have actually generated for that hedger a 500,000, basically the difference between the price he entered into, the 1,000, and 900, which is the settlement price or the price multiplied by the multiplier, and the hedge just made him a gain of 500,000 Saudi riyal, and meaning that instead of having a loss of 1 million Saudi riyal, he have managed to reduce that loss by 50% to have a loss of around 500 Saudi riyal, 500,000 Saudi riyal. That's if he decided to close the hedge. He would have two choices: he'd either close the hedge or roll over. And when we say roll over means basically closing this position and entering into a new position. He will roll it over. He will push it forward. He will take it further in the future. But in order to take it further in the future, you need to settle the current one and then take it further in the future. And by settling the current one, which is in this case the September 20th contract, he need to settle that. He will take the 500,000 gain that he made and basically enter into, now he want to enter into, so basically he will do the opposite transaction, close that position, and then again he's a hedger, so he will be selling the future of the October delivery, and he can the initial margin that he have, since he gained, so the initial margin is there intact, so the CCP can actually use the same or part of that initial margin to enter into a new transaction for October delivery, a 1 month time delivery. So this is a simple case of hedging, and I just had a brief light on basically a little bit more on the hedging angle. So what if the hedger is trying to utilize this instrument SF30 to hedge his portfolio of assets that are not exactly matching the components of the MT30? For him to do that, a hedger in this case to account for some level of imperfections between his portfolio and the MT30. It might be to utilize certain techniques such as optimal hedge ratios, i.e. the beta of the portfolio, to partially address such a situation. There are also further actions the hedger can take to either tail the hedge, also adjusting for his beta. And when I say adjusting for his portfolio beta, he would be able in that case to increase risk or reduce risk. And I guess that's a topic that we can cover at a later occasion if need to be. I mentioned previously the concept of basis risk. It's important also to when we talk about the optimal hedge, there are more than one thing that need to be in place, including the absence of basis risk, which is basically means that assets in the portfolio is exactly the same as that underlying the future. Also, the hedging horizon is matching perfectly with that of the future maturity. These are only two factors, among others, factors such as liquidity mismatch that can also potentially introduce that basis risk. Of course, we're just doing here an introduction to derivatives, so there are a lot of more factors to consider as you attempt for an optimal hedge. And frankly speaking, in most circumstances, a perfect hedge is difficult to attain due to the simple fact that some hedgers will always be questions of using some historical observation as a predictor of future trends. So move on. Here in the example here, talking about the same. However, in this case, it's not an index future; it's a single stock future contract. The same idea, but if you can look, the tick there was around 0.5. We're talking here about a tick of 0.05, i.e., the tick value in Saudi Riyal is Saudi Riyal 5 Riyals instead of 50. Multiplier is the same, 100. The contract price there, 49.95 and 50, and the contract value. And the idea is exactly the same, zero same. So when we say a multiplier of 100, means it's almost like you're taking a position in 100 stock. So this is the price of one stock, and it's almost you're taking a position in 100 stock, 100 units. How to trade index futures. So this is a good example. We want to first just hear a glimpse of how the long position is looking like in a certain scenario and how the short position is looking like. So when you buy one future contract, let's say August 2nd, you buy one future contract, MT30 index future at 1,000. So that's 100,000, 1,000 multiplied by the multiplier. So that's your exposure. Your exposure is 100,000, and you are a buyer. You need to put the initial margin for that percent, which is 10,000. Now, what happens in the month of September? If you are long, if the market went at the 4th of September, went down, it goes down to 980, and you have entered the position 1,000, you are long. It's clearly and obviously it's a loss for you. So you just the difference between them and multiply it by the multiplier. You would find out that this is 2,000 Saudi Riyal loss that will be deducted from your initial mark. So when you look at the end part there, at the return side, when you look at that, you would find that you have put 10,000 as an investment, and you have lost 2,000. And when you look at that a return on capital, you would see that that constitutes 20% loss. Now, what if same case, the same prices? What if you are trader B is a short position in this case? So what if you have actually shorted? You would be making the exact same amount of profit. You would be making the same amount, which is 2,000, but instead of having it as a loss, it would be a profit. Instead, the return on capital would be a 20% return. Why? Because you basically the market have went down, and you short that position using the future, at 1,000, market went 980, and you made 2,000 on your capital invested. Initial margin makes a 20% gain. And the minimum margin requirement, of course, are set by the CCP, and it will vary depending on the type of customers. Now, what if we compared between buying an underlying share or single stock future contract? And this is a very good example, as I mentioned previously, on the leverage component. So what we are currently having right now is that you do buy the shares. So if we're talking about the company ABC, whatever company it is, you want to buy 4,000 shares at Saudi Riyal. The price of a share is 25, and shares value in this case will be 100,000. So you have exposure of 100,000 to that company. Definitely, you'll need to pay the whole 100% of that amount. So you'll need to put 100,000 Saudi Riyal. There is no initial margin here. You need to, because you will just buy you'll buy the shares. So that's in 2nd. So in the 4th of September, the price, luckily for you, it went 2 riyals. It increased by 2 riyals. So we are talking about Saudi Riyal 27 now, and you own 4,000 shares. You will be selling those 4,000 shares. So the value of selling the shares will be around 108,000, and you will receive the whole 100% of that amount. You just sold 400,000. Sorry, you just sold 4,000 shares. And how much did you gain? You gain 8,000 riyals. And I guess that's straightforward. But however, look at the return on capital. You invested 100,000 and you just gained 8,000, and that constitutes 8%. What if the same, I would say, features, exposure, but with different mechanics or dynamics, where you want to have the same exposure, but you don't want to do it by buying stocks, you want to do it by buying a single stock future. And in this case, you want to have a 4,000. In order to do a 4,000 exposure of shares, buy 40 contracts in this case, that will put you at a 4,000. So your exposure now is at 100,000. That's 40 multiplied by the price, which is 25, multiplied by the multiplier. So you get to have an exposure of 100. But the beauty of this is that you just need to put around 20,000. In this case, the initial margin is not 10%, 20%. So let's assume it's 20%. You just put 20,000 into that investment. So instead of putting 100,000 in the first case here, you just put 20,000. So what happens in 4th of September? All the 40 contracts, price of 27. It went up. You are a buyer of the future, so you made money. So you sold that contract at 27, and you made 100. The exposure is 108. So basically, you made the same 8,000, but the difference is, and of course, you received back your margin, your initial margin, what you invested is 20,000. So you receive that back. There's no need for it now. And what happens is that from a return on capital perspective, you just put 20,000 and you got 8,000, and that's a 40% on capital compared to an 8% return on capital. And it's very important to understand that this is a lucrative deal and a very nice one, but it also can have the opposite side. So if the market went against you, it was the other way around, you would have also a significant return on capital. And basically, it comes from the easy concept that you're entering with a little amount of money, huge or a big exposure, a significant exposure. So movement in that exposure can have a quick and direct effect into your invested amount. So margin requirements. This is how just basically it looks like. So when you do an order to buy index future, you're the investor. It goes basically to the exchange participant. From the exchange participant, it goes that's the member, that's a certain AP, and then it goes to the exchange, and from the exchange it goes to the CCP for processing. So the idea for initial margin is that it's around 10,000 Saudi riyal, or 10% out of that exposure, and it's looked at as it is a collateral, and need to be deposited upfront. Risk is basically calculated by the CCP, and when it's normally done to cover the 99th percentile of scenarios that will of that price fluctuation of that underlying. So every underlying have its own characteristics, and you would be also a different initial margin if the underlying is different. The variation margin, this part is important. It gives you a sense of if you have just invested and you're actually monitoring your account. So it gives you an example of if somebody bought a one index contract of 100,000, and you just put an initial margin of 10,000. Now the first column here, it shows that that's the position 100,000, and as it increases, look what happens here. It's 100,000, it becomes 100,500, and that variation here, it's 500. And if you are a buyer, you have just gained 500, and if you're a seller, you have just lost 500. And what happens to your collateral account is that you enter 10,000 here, the buyer entered 10,000, the seller entered 10,000, both the same. However, the buyer in day two have just gained 100, and the seller have just lost 500, and he will see his account, the seller, as it's 9,500 in the second day. And as we go, you would see the movement here. So the movement is 1,500. So from the 100,500 to 99,000 is 1,500 movement, and that's the variation, and it's down. So it's negative for the buyer and it's positive for the seller. And look what happens to the buyer in this case. He was just in the second happy with that initial margin of 10,500, and from the third day it became 9,000. Yet the seller was losing, and the third day it's 11,000, and that's what happened. Big move happens in the fourth day. Price jumped to 106, and look what happened to the buyer collateral account, jumping to 16,000, while the seller, his account most probably will be there will be a margin call here, as his account is around 4,000. So that's a concept, an important concept of future, and this is what marking to market is, and this is what happens for the CCP to manage these kind of position, and this is what you should expect if you decided to futures. We explained margins. Muqassa is the entity that sets a minimum margin requirement for each contract traded on the exchange. It's based on the volatility of the underlying share. It can change from if the underlying is different. So, and Muqassa part of its tasks will be monitoring the market conditions and risks as necessary, raises or reduces its margin requirements as appropriately. Or as needed, sorry. And initial margin, again, the concept of initial margin is very important, as we explained it here more than once, is basically the minimum amount paid by the buyer or seller as a deposit at the time of trading. Depending on the product, it would typically varies between 5% and 20%, the initial margin you would need to put. Yes, an initial margin is either credited back to the account once a position is closed or expired. And there's here an example for you on that same concept. Variation margin is the margin that's settled daily, and this is the more mark-to-market margin that some profit or losses at current market prices. So a position that loses money is debited with variation margin, and a position that gains money is credited with a variation margin. And this is the important concept, and it'll not offset the initial margin. And the variation margin must be funded in cash by the investor on the same day as the call. And there is an example. Look how the variation margin in the cases of a market going up, or in the case of market going up, however, we have investor that is long or investor that is short. So end of day margin call. So all collateral accounts have an end of day margin collateral evaluation, and any deficit on this account, no matter how minimal, will result in a margin call. And these are the times that you would be expecting for margin calls, so either for initial margin or variation margin. So the concept of margin and future trading, exchange traded future trading, is very important. And any investor or trader, any trader actually, who is actually either a speculator, a hedger, an arbitrager, whoever is jumping into or going into this market, he need to understand the concept of margins and how these margins do happen, and what's the effect on his actual cash management and cash position. So key points. It's important to understand that the MT30 index contract is not an investment product used for trading and hedging. The MT30 index is not an IPO. The value of the MT cash index, which is the underlying for MT30, is available on website, on Tadawul website. So Tadawul website is very rich with information regarding the MT30 and soon in the future index too. It is another alternative to trading the market. So if we said that the MT30 percent of the market, so this is an alternative for someone to actually trade the market. And again, by design, a trader can actually exit the position by doing the opposite trade. If it's short, he does the opposite and he goes long. If he's long, he does the opposite and he goes short. So you do not need to wait until the settlement day in order to exit a position. And derivative has a leverage factor. The leverage is a double-edged sword. It can make you money and you can lose money also. So that's important. And this is a market that also depends on margin requirements, and it's very important to understand these margin requirements. So this is some of the futures terminologies. We just explained long, we explained short, the volume. Open interest is an important concept. So the number of that is outstanding in the CCP and which are not settled. It's important to know that the open interest does not always is equivalent to the volume. Sometimes you get a volume that is higher than the open interest, because sometimes you'd find traders who actually open the position and close the position within the same day. So these are not outstanding trades. So open interest is different than the volume. Daily settlement price, very important. It's the volume weighted average price of the last 10 minutes trading day, subject to a minimum of 10 trades. So in the last 10 minutes, 10 trades, volume weighted average. And if there are less than 10 trades last 10 minutes, then the exchange shall use the what is called the theoretical future price. You can find the formula for the theoretical future price in Tadawul website, where it computes how the future is calculated. We explained also in margin, variation margin, margin call. This is where a demand notice from the broker to top up margins if market went against you, you top up these margins to bring them back to the initial margin level that you have entered into. That's an important concept. Intraday margin calls happens when the price moved rapidly during the day. Future expiration is the last trading day of the future contract. Final settlement price, the settlement price on the future expiration day. In physical delivery, i.e., you are accepting delivery of that physical underlying. In the case of index, it's cash settled. But when you hear the word physical settlement, imagine if it's not an index that is underlying, if it's any other thing that you can actually, if it's stock, that you would actually have the stocks in your portfolio, so you would accept delivery of these stocks. Cash settlement is just taking the difference in the settlement price and your buying price or your selling price, depends which side of that you are. Position limits is the limit that are put for this is when this is basically the net long net short concept. So this is a position limit that are set that you need to abide by. So the clearinghouse is confining this not to go what they call, this is more of a directional risk, that there are too much long in the market or too much short in the market. So there is a confinement around the limits here. However, you can get exceptions or exemptions, sorry, if you're a hedger and you can prove that I'm entering into this position because I do have an underlying that justifies that. So that wraps up our introduction to derivatives. There are some useful information here. This is just to give you a glimpse of the specification you would expect from the future index. Look at the details here. Most of this information is things that we have covered here within the presentation. Tick size, daily price limits. We're talking about 20% daily price limits. The daily settlement price, contract months, Thursday of the expiry month. If it's a holiday, then expiry will move backward to the previous trading day. And you can see also down there the margin multiplier, the institutions at 100%, tier 1 individuals as defined, 133, tier 2, 200. So this is some useful. Thank you very much for listening and being in this workshop. Hind, I hand you the microphone.